of top U.S. leadership, but it was the presidents who were speaking to one another and to the media.
Yeah, and you saw today that Vice President Vance did not speak in that Oval Office
Presidents
session and did
who
not
were
speak
speaking
here
to one another
at
and to the
gathering of
media.
world leaders. Obviously, he's a number two, and that table was for number ones only. And so that was an interesting change of personnel, I guess you could say. I think if we stopped here and there was no more news today, this White House would say this has been a tremendous success today. Friday, they would say, was a success because the president got Vladimir Putin talking and got him to agree to this idea of security guarantees on one level or another. Today, they will say, is a success because you had the president convening these world leaders, showing united front with the Western world, and pushing for peace, which is his main goal here. So what we'll watch for is the language and the rhetoric from these world leaders after this meeting today as they depart the White House. We'll see what else they have to say and see if they can put some more meat on the bones in terms of what exactly these security guarantees will be and what the U.S. role in particular will be. That has the potential to be very controversial. Security guarantees will be in the United States for the president, particularly among his political base.
I think that's the point that, at least part I was trying to make with Michael O'Hanlon, is the praise that you heard from these other world leaders to the president in the room felt more genuine, if you will. I mean, hearing the head of NATO talk about being really excited at the possibility of being able to end this war and make some kind of deal out of it, and the other world leaders who were there telling the president directly that whatever his outreach and whatever form it was going to be to Vladimir Putin has had some kind of positive impact on them.
Yeah, I mean, I think that's the right read here. I mean, these leaders do see this as a moment where, the president has, shaken up the Yahtzee table and reset the game pieces. And now they have the possibility to maybe find a way to get to a deal. As complicated as that is, and you heard the president acknowledging just how complicated and daunting it can be, but maybe a glimmer of optimism here in what has been a very bleak and tragic story so far.
Eamon, we'll see how the rest of the day unfolds. Appreciate your reporting as always. Our thanks to Michael O'Hanlon of Brookings as well. We'll monitor the events out of the White House today. We're obviously watching what's happening here on Wall Street because it's a very, very big week given the Fed gathering that's going to happen out in Jackson Hole and where market expectations are in terms of rate cuts and how investors have positioned themselves. Let's talk more about that with Solus Alternative Asset Management's Dan Greenhouse, New York Life's Lauren Goodwin, and Capital Area Planning Group's Malcolm Etheridge. It's great to have everybody with us. We'll turn, Dan, our attention from the White House to Wall Street, where we do have all of this anticipation now about what could be said at the end of the week. Are we in wait-and-see mode until we actually hear from Chair Powell?
I don't think there's any doubt that we're in wait-and-see mode. There are two obviously strong competing views about what the Fed is likely to do, what the Fed should do, what the Fed could do, what the president should or could do in response to what the Fed should or could do. So I think market participants are pretty divided, and so I think we're definitely in a wait-and-see mood. My own personal view is that I think the bias is still for them to reduce rates by 25 basis points at the September meeting, but I certainly think 50 basis points, which was always a really unlikely outcome, is now basically dead in the water. And the question is, how does the chairman frame the debate that's currently being had both inside and outside the Federal Reserve?
Malcolm, how do you see the events of this week and their importance to where this market goes from here?
Yeah, I think to Dan's point about 25 basis points now versus potentially 50, if you're a stock market investor, the Jackson Hole conversation, even if it results in a September cut, doesn't really matter for you nearly as much as the AI conversation we've been having for the last year and change, right? So as long as you have the likes of Microsoft, Alphabet, Amazon, and Meta scheduled to spend a collective $350 billion on investing in AI infrastructure just this year alone. That is the story, the narrative that's carrying the market. So a couple of interest rate cuts aren't really going to matter for those companies or any of the other hyperscalers who don't have to borrow to make those investments. They can cash flow it themselves if they choose to. And so I think Jackson Hole will be important. I think a September cut versus later this year will be important. But for stock market investors specifically, it really isn't going to move the markets.
Lauren, what are your thoughts? I mean, I thought it's interesting that we still have a considerable debate from the Wall Street houses, if you will, on what the Fed's going to do over the remainder of the year and into next. Goldman's sticking with 3 cuts this year and 2 next. Other firms are saying none this year. There was one other that said, well, we'll get 1. Does any of that matter for where stocks would go between now and the remainder of the year?
I think it does matter because the market has really coalesced around the idea that no matter what the pace of rate cuts, the Fed is in a prolonged cutting cycle. I think the challenging reality for that narrative is that I'm on the side of defense that says the data, though we have some evidence that cutting could make sense in the near term, it's not a clear-cut case for the Fed. And the points that Malcolm's making around AI investment, the reality of the broader sense of policy uncertainty that's making its way through the market over the remainder of the year, those are contributing to that case that not only are the economic conditions not necessarily requiring a cut, but financial conditions aren't necessarily requiring a cut. And so I think the narrative that the Fed is moving towards cutting over some timeline is the most important piece. Exactly when and how frequently isn't as important right now.
Dan, I like Malcolm's perspective on this, that essentially what's happening all around us is noise in the face of what is an undeniable and long-lasting trend of AI and this transformative impact that it's having not only on these companies, on these markets, the way we're all going to think about living, working, investing in the years ahead. Goldman's Tony Pasquarello today says, one specific point to underline here is my long-standing bias for large cap over small cap. There's good reason to still believe in the fundamental underpinnings of that trend.
I agree with a lot of what Malcolm had to say. And the sentiment, again, to repeat, is just you've got this secular theme that is driving the market. And for the 100th time, Malcolm's made the point, I've made the point, Dan Ives has made the point. This goes beyond NVIDIA and Broadcom. It goes down to Amphenol and GE Vernova and Vistra and Vertiv and Eaton and Trane Technologies and all the other parts of the S&P 500 industrials, utilities that are benefiting from this secular trade. And if we think about this, and I've talked about this a bunch, I know Dan Ives, who's coming up later, has as well. If you think about this through the late 90s, the number of times people told you in the late 90s, subsequent to the Netscape IPO, the number of people wrote about and discussed market valuations being excessive, and it's a bubble that was forming, et cetera, was innumerate over those 5 years. And it wasn't until, and this is the most important point, it wasn't until 2000 when you had the DOJ stepping in to prevent some additional mergers, which had been a huge driver of the gains, and profit warnings from Intel, from Lucent, from Sun Micro, et cetera. We're nowhere near even really a slowdown in cloud growth, let alone profit warnings. And I really think more to Malcolm's point, as long as that trend is in place, yeah, the Fed matters. Lauren's right. As long as you're skating towards lower rates, that's a positive. But that theme is playing itself out and is unimpeded at the moment.
I thought, Malcolm, that was part of Rick Reeder's point last week that he made on this program, that you can have a problem with valuation of those AI stocks. But when you look at the degree in which they're growing their earnings and they are at the forefront of what's truly happening, and it doesn't look to be slowing down anytime soon, if you pair that with the idea that, well, the Fed is going to be cutting rates at some point, it may not be on the calendar that certain people think, want, or expect, but there are enough things that you can put 1 + 1 + 1 + 1 equals a pretty darn good outcome for these markets.
Well, the last 2 earnings periods have made that case too, right, Scott? So we had the questions last year of, have the hyperscalers gone too much too soon? Have they invested too many dollars? Are they committed to too much CapEx? And that started to weigh on that growth narrative. And then this year, so far, the first 2 quarters, you had the likes of Microsoft, for example, or NVIDIA, who showed up with bang out numbers once again, proving that there really is still demand and not enough supply for all of these different critical components, to Dan's point, of the AI infrastructure and the AI arms race. That's proving in real time. It's not a thing that we have to wait 3, 5, 10 years to see how are these investments going to pay off? Meta's already delivering results each time they come to us with earnings. And so they are defying gravity from a earnings multiple perspective. But I think they're also earning a little bit of headway. And that is really the narrative that I think stock market investors, again, should be paying attention to. If you're a bond fund manager, obviously every quarter point matters to you. But realistically, unless we're talking about more than a 50 basis point cut at any of these 2 or 3 Fed meetings that we're expected to have before the year is over, and that's what's supposed to drive the cutting pattern, unless they're massive cuts, I just don't think that it's really going to be enough to rock the confidence of any stock market investor who's really been paying attention.
Lauren, do you think the broadening trade, so to speak, is the biggest wild card this week?
I want to pick up on one of the elements of Malcolm's argument, which is that we've been talking a lot about equity investors, but a lot of the news this week is impacting other asset classes as well. And I think this is a component of an asset allocator's challenge right now that's really, really important. Mentioned a little bit with respect to Jackson Hole this week and the Fed, that 25 basis points now or in a couple of months probably doesn't make a ton of difference. But that promise, let's say, or assurance of some sort of cutting cycle is even more important in the face of the broad range of policy uncertainty that we're seeing. I mean, we're talking earlier in the program about war, energy security, defense, geopolitics. These are all elements of the policy backdrop that are impacting and have caused a major freeze up in asset classes like private equity and that private equity, private credit landscape. And so moving towards a direction where the Fed could be signaling a little bit of easing actually contributes back to the public equity markets by unlocking some capital out of other elements of the public and private markets.
Guys, we'll leave it there. Appreciate it very much. Appreciate you rolling with us, too, through our breaking news. Dan, Malcolm, and Lauren, we'll see all of you again soon. Up next, star analyst Dan Ives. He's changing up his AI revolution list. The names he is adding, the ones he is dropping, we'll bring them to you next. What's up?
Famous to bold.
Welcome back. Is the AI market in a bubble? That's what OpenAI CEO Sam Altman is warning, saying over the weekend, investors are, quote, overexcited about the AI trade. Joining me here, Post 9, is star Wedbush analyst Dan Ives. He is as excited as his coat is bright, right? I mean, is Altman onto something or no?
Look, I mean, I believe we're only in the second inning of a 9-inning game. I mean, because it's our view on the enterprise side, it's just started to play out from use cases. I think as we go into the consumer and ultimately what's going to be autonomous and really the derivatives, I mean, Scott, it's my view the next 2-3 years, we have a tech bull market, and I think AI revolution, the actual impact over the medium and long term is actually being underestimated.
Is he doing a Greenspan here where he sort of waves the flag, but we don't see the results of the hurricane until years down the road?
Yeah, I think it comes, look, and Altman obviously being the golden child that we see when it comes to AI, I think what he's talking about, there could be some froth at stages or parts of this.
Could be.
But, well, especially when you talk about some of the valuations on some, maybe on the private side, what I see on the public side, I see ultimately demand that's 30 to 40% more than I saw 3-4 months ago. I see a CapEx, ultimately really a transformational CapEx that I view as a fourth industrial revolution.
There's no question about a transformational CapEx. Does the return on the CapEx meet the moment or not? That's what we're all going to be boiled down to. We have built in assumptions. You and every investor who's buying these stocks have done that. It has to result in something where you get a moment like Dan Greenhouse was talking about when the bottom eventually fell out in 2000.
Yeah, and I think what Dan's talking about, and to me, the last quarter and what we're seeing out there in terms of earnings, it's actually been a validation moment for AI. And it's our view that when we look out over the next 12, 18 months, I think as you look at the second, third derivatives across software, cybersecurity, autonomous, I believe investors are actually underestimating where we believe, look, it speaks to our view where this tech market's going. And I get the skepticism, but they'll continue to prove it wrong. I think quarter after quarter.
Okay, you're adjusting the way that you want to, the way you want investors to look at all of this through your AI 30 list, where you've updated it with additions and subtractions. You've added CrowdStrike, Roblox, GE Vernova, and Nebius Group. You've taken off C3 AI, Cyber, following Palo Alto's deal, Adobe, and Elastic.
Yep.
So, I mean, I think people can look at Adobe and figure out why you've removed it. Some would question why it was even on there in the first place if it was an AI 30 list when they apparently, according to the investment community and the markets, clearly are being left out of that conversation. But why crowd in terms of AI? GE Vernova is, I think, well known by everybody as to the power portion of this, and Roblox.
Yeah. So crowd, first, when it comes to cybersecurity, I actually think first Palo Alto, which obviously we were reporting later, Zscaler, and I think CrowdStrike, you're going to see AI play more and more of a role in cybersecurity. That's actually to us one of the biggest beneficiaries when it comes to second, third derivatives. I think CrowdStrike is not being factored in enough. You talk about some of the infrastructure plays, Nebius, being a core one. And to us, look, when it comes to Roblox, I mean, it's our overview of gaming, what's happening on the consumer side. I mean, you are seeing AI transformation that's happening across the industry. And to us, the whole goal of the AI 30 is to capture based on whether it's software, chips, consumer, autonomous. And what I believe, this is a golden age for AI. It's not just about 3-4 names.
All right, good to see you. Thanks for being
Great,
here. Dan Ives, Wedbush. Up next, top strategist Chris Ferrone's with us. He says investors are banking on a rate cut. So which sectors stand to benefit the most? What happens if we don't get one? He'll tell us next. All right, markets begin the week with all attention on Jackson Hole. That's where the Fed holds its annual gathering. Rate cut expectations have sent stocks to new highs lately. Let's bring in Chris Ferrone from Strategas for his insights. But that's what we're trading on, right?
Yeah.
I mean, rate cuts. The hopes and dreams of rate cuts?
Well, I think that's been the leadership message, particularly the last 4, 5, 6 weeks. And really even pre-August payrolls, the soft print, you began to see stuff like home builders, biotech, small caps start to come to life. And, it's been a welcome rotation as some of the bigger stocks, some of the AI-driven stories have churned here. So we certainly welcome this message to the more economically cyclical corners of the market. I think it continues to portend pretty good things down the road.
Oh, so you believe in it? I mean, I was going to say, if we don't get the payoff, what happens to the home builders, the biotechs, and the small caps? I mean, they're already kind of acting like they're not going to get what they want.
Well, I think you're beginning to see legitimate trend changes. And again, this predates the last several weeks. I mean, these home builders began to turn 3 or 4 months ago. You're getting trend changes in all of them. D.R. Horton, Lennar, Pulte, Toll. Look at some of these global autos, which, again, I would argue are very much at the forefront of the economic cyclical story we're trying to tell here. Things from Toyota in Japan to even GM here has acted well despite a news flow or a macro setup that would argue against owning those stocks. So I welcome when things act differently than maybe the news might suggest.
So when you say the story we are trying to tell, are you talking about you
Yes.
guys, your firm?
Yes.
So you're real believers that we're going to have a broadening out? Do we have money come away from mega cap into all of these underloved areas?
I think it's unappreciated. The equal weight S&P is also at new highs here. Now, we can talk about whether small or equal weight is leadership.
Doesn't take that much to get a new high. I mean, does it? The equal weight?
Well, I mean, we're talking about
really
500 stocks typically
anywhere.
weighted
No.
with a big corner of the market. You talk about these small caps, 50-day up through the 200-day now. You look at what has worked within the small cap arena. Industrials, economically sensitive, very potent, and the fact now that you're seeing small cap healthcare, which is a very large weighting in Russell 2, come to life again, I think reflects an environment where you have kind of the best of both worlds. You have short rates coming down. You have the long end of the curve relatively stable. I think it's a good message that steeper curve, the economy's in decent hands here.
Some call it bear steepening, but I mean, do we have to have cuts for this to work or no?
I think with the 2-year yield at 375, the market's telling you a modest easing cycle is likely in the cards here. And we always joked in our work, we'll listen to the 2-year yield over any Fed speaker any day of the week.
Well, that's the Gunlock perspective too.
Yeah.
It's like the 2-year leads the Fed.
And 75 bips below where Fed funds is, I think, is a good enough reason right now for the Fed to at least give you 25 into September.
Okay.
And then we can talk about what the fall
You
brings.
think we're going to get more this year?
I think we'll get one more this year, and it sets you up. We're talking about home building or housing, maybe for a better than expected spring selling season. I think that's what these home building stocks might be starting to pick up. Remember, Scott, these home builders have been in a bear market for 15, 16, 17 months. They went down 40 or 50%. At what point is the news in all of these? I suspect it's probably here.
We'll leave it there. Chris, thanks.
Thank you.
Chris Ferrone, Strategas. Coming up next, Bitcoin sinking after hitting a new record high. What's behind that drop? We'll take you inside the market zone and tell you. Closing bell market zone time. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day. Tanaya McKeel is tracking some big moves in crypto for us as well. Michael, this says everything about what happens this week because the big events happen later this week.
Yes.
And this market wants to see and hear what happens in Jackson Hole before it decides what to do.
Rarely does the market truly wait and see as much as it's waiting and seeing today, at least at the index level. The S&P 500 seemed to get enough out of the CPI report last week to gain some confidence that we're likely to get a September cut. And the S&P's been almost dead flat for 4 trading days since then. Below the surface, it's trying to find things to do. For example, you were talking about the small cap outperformance. The 12 worst stocks on a year-to-date basis are all up today in the S&P 500 by an average of more than 2%. So people are trying to rotate around and feel like, let's see if we can grab any of the left behinds. But beyond that, you're right. It's mostly about, let's see if the story changes based on what Powell has to say late this week.
Yeah, let me take a little bit off of Bitcoin. You see some of the, trades like that.
And the pressure on Meta and a little bit of a slight cooling off of the AI trade and maybe a little bit of a rethink on that. And the rest of the market kind of takes up the slack on a one-day basis.
So, Tanaya, Bitcoin's at what, 116,500?
Yeah, that's right, Scott. Today, at one point, dipping below 115,000 after touching almost 125 a few days ago. Ether going down with it as well after nearly hitting its 2021 record at the same time, which we don't see a lot from these two coins, Scott, the two of them going to all-time highs together. The altcoins and some crypto stocks may have shown euphoria as of late, but action in these specific coins, I think, looks more like conviction and validation from institutional investors. So what happened? The market was highly leveraged and highly long. Crypto rolled over after that higher than expected July PPI raised questions over a September rate cut, and it triggered this wave of forced selling of long positions. I also want to note, though, that was Bitcoin's 4th new record in 2025, and so far those drawdowns that follow have been getting smaller and smaller each time, Scott. So there might be more chop this month out of the crypto space, but not, I don't think, for lack of conviction. Scott?
Okay, Tanaya, thanks so much for that. That's Tanaya McKeel. I'm looking, Mike, at the VIX, barely budged today. It's up a little bit.
Yeah.
I mean, things will get a little more nervy, I think, towards the end of the week as we really try and guess whether, this version of Chair Powell is going to lean a little hawkish, whether he could dictate what maybe the market takes as its hawkish cut coming. You're going to have everything parsed. Remember, 8 minutes is all his speech was at the beginning of the hiking cycle.
There's absolutely a chance that he injects some ambiguity or just some essentially contingency into the story. I don't know if he wants to front run the series of inflation and employment numbers you're going to get between this Friday and the September meeting. I do also feel as if the market itself, with consumer cyclicals holding up really well, with industrials still doing their part, with financials working, the market itself isn't telling you the real economy desperately needs a rate cut. So it's almost like it would be a nice to have, it would be kind of insurance. If there was a growth scare underway, it would look more like it did last year at this time when it was 10-year yields plunging, the market implicitly saying the Fed was way behind the curve, and you had to essentially ramp up your expectations for a recession possibility. We're not seeing that right now. Does it mean the market doesn't want confirmation we're getting a cut? No, it wants it. It just doesn't necessarily feel as if it's make or break at this point. It's then again a little bit circular because maybe those sectors are doing well because we fully baked in or almost fully baked in a rate cut. I don't think that's all the story is. But, you know, it's like the market is starting to stall out a little bit here momentum-wise, but really you're not seeing any sellers get aggressive and engaged on that side except in isolated pockets.
Okay, so we'll go out. What we said was a bit of a mixed picture, kind of a ho-hum trading day as all eyes are on Jackson Hole, and we're certainly waiting for more developments out of the White House today, too. Doug, for us, OT and Morgan.
Well, that's the end of regulation, taking stock, ringing the closing bell at the New York Stock Exchange. Comedian Jeff Ross doing the honors at the NASDAQ. A quiet day on Wall Street as investors await Fed Chair Powell's Jackson Hole speech and an onslaught of retail earnings later this week. The Russell was the main index to close in the green, up fractionally. It looks like the NASDAQ also just above the flat line here, but the S&P and the Dow both finishing lower. Treasury yields edging slightly higher. Industrials and consumer discretionary were the sector winners today. Communication services and real estate lagged. On the commodities front, oil, Brent moving to the upside today. Gold on the flip side closing at the lowest level since August 1st and posting its third straight day of losses. Bitcoin and Ether moving lower. Both coins rolled, I should say, over that after that higher than expected inflation data last Thursday. Some investors pointing to some profit taking here triggered by a wave of liquidation across the broader crypto market. That's the scorecard on Wall Street. Welcome to Closing Bell Overtime. I'm Morgan Brennan. John Ford is off today. A historic meeting in Washington as the leaders from some of the biggest European countries gather to discuss the Ukraine-Russia war. We're going to dive into the headlines and what could come next. Plus, are economists too bearish on growth prospects and too concerned about inflation? Well, our market guest says yes. He's going to make his case. And Goldman Sachs says this has been one of the best earnings seasons on record. Will this week's big round of retail earnings keep that streak going? We've got the numbers to watch and the stocks to buy ahead of the results. But we begin with the big meeting in Washington today. President Trump sitting down with European leaders as the administration attempts to broker a peace deal between Russia and Ukraine with the war now in its fourth year. The leaders wrapping up that multilateral meeting in the last hour. Let's head to Eamon Jabbers at the White House for more. And Eamon, Ukraine's President Zelensky was there as well. Quite a few dignitaries.
Yeah, absolutely. You rarely see a power player line up like this at the White House today. They are behind closed doors now, the European leaders and President Zelensky, along with President Trump. So we'll wait to see what they say when they emerge from their meeting. But a strikingly optimistic tone from both Zelensky and Trump in several photo ops and Q&A sessions with reporters in the run-up to the meeting that's going on now. Both men at pains to suggest that they want to achieve peace, they want to end the killing, and they want to see some kind of a deal here that Ukraine can agree to, along with Vladimir Putin of Russia, who, of course, President Trump met with in Alaska on Friday. The president, for his part, in a multilateral meeting with world leaders, laid out his vision for what he wants to see. Here's what he said.
Optimistic that collectively we can reach an agreement that would deter any future aggression against Ukraine, and I actually think there won't be. I think that's even overrated, largely overrated, but we're going to find out. And I think that the European nations are going to take a lot of the burden. We're going to help them, and we're going to make it very secure.
The headline so far, Morgan, is that the president has not taken the option of U.S. troops in Ukraine off the table in discussions so far today. He has suggested that as part of those security guarantees, the Europeans will be on the front line of providing those security guarantees because they are most impacted. But he says we will be involved. That is, the United States will be involved in some way. What that actually means, whether he's envisioning boots on the ground of U.S. troops in Ukraine as part of a ceasefire agreement, that's unclear. And they said, all the leaders said that they were going to go behind closed doors and hash out, in Trump's words, who does what in this security guarantee. So more to come from here, Morgan.
And I realize this is very complex negotiations. There's a lot of different parties involved here. But given the fact they're now meeting behind closed doors and the expectation is that's going to play out here for perhaps the next couple of hours, is there an expectation that we could get some more meat on the bone in terms of what some of that looks like, or just too soon to tell?
I mean, I think it's too soon to tell. President Trump is clearly moving on an expedited timeline. He said he's going to have a call with Vladimir Putin immediately after this set of meetings today to go over with him whatever emerges from this. So the President of the United States wants to move very quickly here, and he's been talking throughout the day about the idea of a trilateral meeting with the three world leaders all in one place at one time to hash out the future of Ukraine and Russia. Not clear that everybody on the European side is on board with that. The Chancellor of Germany suggesting in the multilateral meeting that the part of which the press was allowed to see, suggesting that maybe that trilateral meeting shouldn't happen unless there's a ceasefire first. That is, that Putin has to give something to get something here. So there might be a little bit of disagreement behind closed doors, and we'll wait to see how that all shakes out.
All right. A busy day for you, Eamon, in Washington. Thank you for bringing us the latest. Eamon Javers. So what does today's historic meeting mean, and what can we expect next? Well, Atlantic Council President and CEO Fred Kemp and Andrea Kendall-Taylor, former Deputy National Intelligence Officer for Russia and Eurasia, both join me now. It's great to have you both. Fred, I'm going to kick this off with you. Ceasefire versus a big, broad peace deal. Do you need one to get to the other? And if not, is a trilateral agreement the next step in a move forward?
Yeah, so thank you for that question. I was on the phone all weekend long with various European officials. Their phone lines were burning. There are two reasons why they came to Washington. One, they were really worried about the outcomes of Alaska and that they were going in the wrong direction. And the second was this glimmer of hope, glimmer of optimism around the security guarantee. So I wouldn't dismiss the need for a ceasefire. At some point, Putin has to stop killing people in Ukraine. But the real ace in the deck is the U.S. joining a European security guarantee for Ukraine, because if you can save your sovereignty, if you can save your independence, you can make some territorial compromises. But why make any territorial compromises if you're leaving yourself insecure and unsafe and you're going to be attacked thereafter? And so that's why you've seen something the president himself said that the White House had never seen before, this bodyguard of European leaders around Ukrainian President Zelensky. It really was something that I certainly have never seen in my lifetime in the White House.
Yeah, and of course it seems assembled very quickly in terms of everybody coming to Washington and being here bright and early on Monday, midday. Andrea, I want to get your thoughts on this, specifically the security guarantee part of this. Are there other examples we could point to of what this would look like? What would you want to see?
Well, I mean, I think this, as Fred said, is really going to be the crux of it. And as Fred said, Ukraine cannot concede any territory unless they have a robust security guarantee. And it was very positive to hear President Trump say that he's willing to participate in a future security guarantee for Ukraine, because that really has been an open question. But the thing that worries me a lot is the devil will be in the details. And as you're suggesting, these security guarantees can take many different forms. And what I'm concerned about, or the thing that gives me pause about being overly optimistic that we're moving in the right direction, is that the Russian side has been quite clear that they're not willing to accept many of the parameters of a security guarantee that we think, that experts think, would keep Ukraine safe. So we have the Russian side saying that they're not willing to accept NATO or European troops on the ground in Ukraine. You have the Russian side saying they want very strict limits on the size of Ukraine's military and its defense industrial base. So there's a lot of things yet that we need to work through in order to be, I think, optimistic that we can get to a deal.
Fred, I want to ask you about something you've been writing about, and that is Europe's strategic moment, the fact that it's here, whether they like it or not. What do you mean by that? And how does all of this play out now when you see so much investment starting to finally move forward for things like defense spending on the continent?
Yeah, so look, you see the United States wavering in its security commitment to Europe overall in the Trump administration. You see Putin menacing. And so what I mean by strategic moment is Europe either has to stand up and fill the defense and security needs and responsibilities of its continent, or nobody else will, and they'll be left to others' decisions. Now, the problem at the moment is they don't have the military wherewithal, certainly not the heavy lift, certainly not the air defense, to be able to provide a security guarantee for Ukraine. So you need a bridge. And so this would be a perfect, I totally agree that one should be a little bit skeptical about how it's going to be very hard to get to security guarantee agreement, let alone to a territorial agreement. Those things are both going to be very difficult. But what's different is the last 2 weeks, we now have an opening we didn't have before to at least start working in that very, very difficult direction. But as the president said himself, and I thought this was just a great quote, by the way, Eamon Javers' coverage on this has just been steady and smart and terrific. But he said that the Europeans have to take on the brunt of the burden, but we're going to help. That's the solution. That the U.S. comes in to help, but the Europeans take on the brunt, and they have to take on more and more year after year. But the U.S. has to bridge to get them there. What can't happen is an abrupt departure of the United States, because Europe is not yet ready for its strategic moment completely. And so I think we can now build on 80 years of commitment of the United States to Europe by providing this security guarantee for the Europes to take the lead, for Ukraine to survive, and then that would be really a truly historic occasion. But it's a far way off. We've got a long way to go for there. I talked to one White House official over the weekend. He said this is a marathon and not a sprint. And my one question is whether President Trump is in for a marathon. Sometimes he doesn't want solutions to take that long, but this one is going to take that long.
Yeah. Andrew, I want to get your thoughts on what it takes to get to a territorial deal, because for years now, all the way up through this weekend, we've been hearing that Zelensky of Ukraine was not willing to cede any ground in terms of negotiation on that. What's changed?
Well, he still isn't. And that's really important to emphasize. He's been very open and public saying that. And there's a couple of reasons. One, Ukrainians, the public opinion. Ukrainians are not yet ready to cede territory. Number two, on this land swap idea, you have to recognize that Russia has been fighting to take this region in the Donbass in Ukraine's east for many years now. And there was an excellent piece out by the UK, the United Kingdom's Ministry of Defense, that said that if Russia continues its current pace of advance, it would take Russia 4 years, more than 4 years, to completely take the rest of this Donbass region. So it makes no sense for Ukraine to just turn this land over. It would also be very detrimental to the military morale to ask a military where they've lost blood and treasure to hand over territory that they currently occupy. So there's a lot of reasons. And then it all comes back to security guarantees, which is where we started. This area is very strategic. If it's handed over, it could provide a springboard for future attacks on Ukraine. So if Zelensky is going to make any territorial concessions, and that would have to be decided by the Ukrainians, it has to be accompanied by extraordinarily robust security guarantees so they can be sure that Russia won't simply attack in the future.
Okay. We'll continue to watch this marathon, not a sprint, but a marathon. Thank you both for breaking it down and the nuances around it, Andrea Kendall-Taylor and Fred Kemp. Palo Alto earnings are out. Meantime, Christina Partsinevelos has the numbers for us. Hi, Christina.
Hi. Well, shares are up about, 5-6%, driven by the higher guide. But I want to break down the numbers for, now 7%. Let's break down the numbers for the quarter. Earnings per share of 95 cents, which is a solid beat versus estimates, with revenues just slightly ahead of what the street wanted. But it's the Q1 guide for EPS, earnings per share of 88 cents to 90 cents. That's a range, is higher than what the street wanted, as is the Q1 revenue guide. One key metric for a lot of cybersecurity software names is the remaining purchase obligation, RPO, and it really gives us a glimpse into the revenue backlog, who's going to spend money in the near term. And the company is guiding between $15.4 and $15.5 billion, which is above consensus. Overall, the report is seen as a positive. There's a lot of long-only funds in this name, especially when you compare it to competitors Checkpoint and Fortinet, which really plunged after their, less impressive guides. Morgan.
All right. Shares up 6.5%. Christina Partsinevelos, thank you.
Thanks.
Let's turn to the broader markets. Stocks were relatively quiet as investors await Fed Chair Powell's speech at Jackson Hole. That's set to take place on Friday. Markets will be closely watching to see if Powell sticks with his hawkish tone. Our next guest says market watchers are too bearish on growth and too worried about inflation. Joining us now is Eric Friedman, U.S. Bank Chief Investment Officer. Eric, it's great to have you on. Let's start right there. Why do you think that's the case?
Yeah, Morgan, great to see you. I think really two things in mind. Number one, you think about the growth trajectory. There's been this almost dismissal by companies of giving really thoughtful guidance about what's in front of them, really because tariff confusion has reigned supreme. So we're starting to see that really peel back a bit. Think about the various sectors that are very consumer sensitive, whether that's leisure, hospitality, financials, the general, consumer zeitgeist is actually getting incrementally a little bit better. Even though there's a lot of discussion around how challenged consumers are, we actually think that at the margin, consumers will be doing a little bit better on the spending front over the next couple of months and quarters. I think the second component is the deferral of decisions by companies is actually starting to really, scale back. If you're in a sector and you've really held off on giving guidance, if you really held off on providing perspectives on your spend, it becomes a bit of a prisoner's dilemma. If you're the only one who's really, keeping cards close to chest, that's actually not a good thing. So we think in general, the growth picture is generally positive. I think the other point on inflation, the U.S. can't really afford to be an outlier on the inflationary front. Just to kind of look at economists' forecasts out the next, let's call it 18 months, economists think that inflation will still be above 3% in September of 2026 versus what we're seeing forecasts in developed markets as well as developing markets at sub 2%. So I think that in general, you're seeing this trend of, really over-indexing on inflation and also harkening back on less growth. We just think that things will be a little bit better on both fronts than what economists are currently thinking about.
There's this funny thing happening in the bond market, and it's not just domestically, it's globally. And that is you're seeing the long end climb higher. And it's not just here in the U.S. either. You're seeing it in Japan, you're seeing it in the U.K. and other parts of the world right now. What is that signaling? Is that a reflection of how sticky inflation is globally right now, or is it something else?
Yeah, I think in Japan, it's definitely something else, Morgan. That's a bit of an anomalous situation just because of what's happening. Unfortunately, such a long period of latent activity in Japan. But really, I think it's an important point you raised because for us as macro investors, we want to see the 10-year sit between 4% and 5%. Sub 4%, that for us would be a growth scare. You covered that a little bit earlier in an earlier segment. Above 5%, that would signal to us that, look, we're wrong in inflation. And in fact, economists may be underestimating where inflation goes. So right now, the 10-year at about 4.35, that's actually a decent level for both borrowing to, probably resume, pick up a little bit later on this year and early next. But again, that sub 4% number, that would suggest to us that consumers will actually really scale back. So, if anything, what we're seeing in Europe is a little bit of loosening of labor laws, a little more animal spirits flowing, which we think is a good thing. But in general, you're seeing the bias from central bank estimates for rates to come down. So again, long end of the curve, very modest pickup, but certainly short end of the curve. People think that ex-Japan, there will be some cuts to come. We think that's a great time to be involved in global equity markets, especially large caps at current levels.
Okay, and of course, we will see what we get from Powell and the rest of the Fed and also some of their European counterparts who will be at Jackson Hole presenting later this week. Eric Friedman, thank you so much.
Great to see you, Morgan. Thank you.
Well, coming up, a big week of retail earnings ahead, including giants Walmart, Target, Costco. What can we expect? And what name should be in your shopping list ahead of those results? Plus, home builder sentiment. It's coming in weaker than expected as builders say affordability remains a big headwind for buyers. We're going to look at what it means for the housing trade with Fast Money's Guy Adami. That's coming up ahead. Overtime's back in 2.
tradingco.com.
Welcome back to Overtime. Well, it's a big week of earnings for this sector, for retail, as Wall Street awaits results from Target, Lowe's, Walmart, and TJX, just to name a few. But first, we're going to hear from Home Depot. That's tomorrow morning, as that stock is on pace for its best month since November of last year. What can we expect from the sector? And are there names that you should be adding to your portfolio? Joining us now on set is John San Marco from Neuberger Berman, and it's great to have you here. Welcome.
Great to be here. Thanks, Morgan.
Okay, let's start with Home Depot. What are you expecting tomorrow?
Great place to start. I think, taking a step back, the broader retail space, it's kind of same old, same old. I don't think 2Q will sound terribly different than 1Q. I think tariffs are being passed through reasonably painlessly. There's just not much incremental excitement. Home improvement is a space where we've gone from bad to less bad to I think this is the quarter where we turn the corner, start to see positive growth. The cycle starts to get better.
Why?
Well, for starters, we're 3 years past when rates initially surged and housing turnover responded to that immediately. And that 3-year number is an important figure because that's about how long a new homeowner spends at an outsized rate on their home. So we're hitting this key point where the new rate environment has been digested, and I think people can focus on what's specific about Home Depot and some of their advantages.
Okay. I know they have a diversified supply chain, and they're making some big acquisitions right now. So how do you stack them up against Lowe's, which isn't necessarily making the same sort of acquisitions?
Yeah, on the DIY side, both I think are very similarly positioned to benefit from a better consumer, more willing to spend on big ticket. But your question alluded to it. What Home Depot's done the last decade, and very aggressively the last several years, they've built the new abilities to serve pros in different kinds of ways. Larger purchases, planned purchases, makes for a much bigger market selling the same product to the same customers, just obviously more use cases. And so all of this has been hidden from the public market, I think, by the cycle. And when we get to just a lukewarm cycle for home improvement, I think some of those things will start to shine quite a bit more.
What are your thoughts going into big box retailer earnings? Especially, I look at like a Target. They've been getting a lot of my money in the back to school spending spree in the Brennan Cacciati household. But in general, we know that it's a name that's been struggling, in part because obviously they get hit hard by tariffs, but also by all the discretionary stuff there.
Sure. Yeah. Big box, I think, perhaps in the other direction. It's been unusually benign competitive environment across general merchandise retail. It's been a long time since competition has really reared its ugly head in that space, and that space can get pretty cutthroat. I think at the margin, 2Q will show us very little. We just haven't seen enough tariffs yet. The consumer's been resilient enough. There was even perhaps some wallet share shift out of services and into goods that made the space look better. But I think this is probably as good as it gets for that space. Target's a little bit different. I think they've had some execution issues, and to your point, they do skew a bit more discretionary than their largest competitors. So it's already been tough for them, but I think there's the risk that it gets tougher for the broader space across grocery, across general merchandise retail.
Does Walmart continue to be a winner here, or are they going to see more competitive action? I mean, think about it, the Amazon report about grocery delivery, for example, last week.
Yeah, they're immune from a lot. They've had so much momentum. They have so much heft. I think when they report 2Q, they'll flex their muscles around those exact things: the volume, the frequency they're winning with customers, some of these future-proofing capabilities they've been building. But no, they're not immune. Amazon making big incremental bets on grocery, making big incremental bets on rural. That's a shot right across Walmart's bow. So that's not to say that they can't defend themselves. They're certainly not helpless, but I do think there's the risk that economics across the space come down in the battle for everyday wallet share and frequency with the customer.
Okay, John San Marco, thanks for joining me here on set.
Thanks for having me.
Well, coming up, investors have raised equity exposure sharply since that April bottom, but it hasn't hit extremes yet. What could that mean for the rally? We're going to discuss when Overtime returns. Welcome back to Overtime. Investors' market exposure has risen sharply since the April lows. While positioning has been moving higher, it's not at extremes, at least not yet. So what is that telling us? Let's bring in senior markets commentator Mike Santoli. Hi, Mike.
Hey, Morgan. Well, it's telling us that not absolutely everybody is crowded on the bullish side of the boat just yet. And sometimes the market can get toppy if basically positioning in aggregate is overextended to the upside. So based on this Deutsche Bank equity positioning gauge, it's not quite the case just yet. What you see is it's risen, but it's about at the 71st percentile over the last 15 years. What that means is it's higher than 70% of all readings, but obviously it's well below where it was the middle of last year and before that, right in the pandemic rally, as well as early 2018. So that's when it's kind of like everybody is in and max bullish. So it suggests that there's at least room for buyers to actually incrementally get more exposed to equities as we go along, assuming the market holds together. What it also would suggest to me is if the market does pull back, there's probably a little bit less downside before you have an attempt to buy the dip. Now, this is all investors in aggregate. So collectively, it's institutions of various types, plus some retail investing measures. And it's kind of slow moving. So it's not all about, the quickest trigger fingers in the market and what they're doing at a given moment. But it does give a sense out there that not, everybody is bought in and is margined up in this market.
Yeah, it's interesting because Goldman Sachs and Reuters did a write-up on it today, but Goldman Sachs basically, said hedge funds are buying U.S. stocks at the fastest pace in 7 weeks in anticipation of Fed rate cuts coming starting next month. We also have other guests on who talk about the, whatever it is, $6 trillion, $7 trillion in dry powder sitting on the sidelines. Does that begin to rotate into stocks, or does that tend to stay separate?
I don't know that that's really where I would look to suggest that you could have marginal buyers come in. Obviously, that creates a cushion for equity positions. And to me, that's what it really means. If you do have that cash sitting there in the system, it means that wobbles lower in the equity index means you can kind of handle it, absorb it, maybe do some buying on it. Most of that money is just cash, and it's, if anything, replacing bond holdings as opposed to being about to move into stocks. I'll also just point out that Goldman Sachs measure, yes, the fastest buying over the course of 7 weeks among hedge funds, but it didn't bring their overall positioning to an extreme high. It's kind of just above neutral at this point. It just sort of shows you that how destabilizing the events of the spring were, how a lot of folks were very slow to trust this market, given all the policy questions until very recently.
All right, Mike Santoli, putting in context, as always. See you a little bit later in the show. Thank you. Well, it's time now for a CNBC News Update with Kate Rogers. Hi, Kate.
Hi, Morgan. Hamas says it has agreed to a Gaza ceasefire proposal presented by mediators from Egypt and Qatar. According to an Egyptian official, the proposal includes the temporary suspension of military operations for 60 days, which would see the exchange of Palestinian prisoners in return for the release of half of the remaining living Israeli hostages. Texas health officials today announced that the measles outbreak in the state is officially over. The state health department says it's been 42 days since any new reported cases. Since it began in January, nearly 800 cases were confirmed in Texas, including 2 unvaccinated children who died. And salaried employees, at Starbucks are getting a 2% raise this year. According to Bloomberg, it's a shift from previous increases that were decided by individual managers. The move coming amid a turnaround plan at the coffee giant where executives have been asked to keep costs under control. Morgan, back over to you.
All right, Kate Rogers, thank you. Still ahead, Palo Alto shares are up about 4% right now here in Overtime. That's after Q4 earnings that were better than expected, better guidance too. We're going to speak with one analyst who calls the firm's recent acquisition of CyberArk, quote, misunderstood. Closing Bell Overtime is back in 2. Welcome back to Overtime. Let's get another check on cybersecurity giant Palo Alto Networks. Those shares are higher, up about 5% right now after a strong beat, but off the best levels. That conference call kicking off in under a half an hour. Joining us now is Evercore Enterprise software research analyst Peter Levine. He has an outperform rating on the stock. Peter, it's great to have you on. Your thoughts on this print, which had better than expected quarterly results, but also it looks like stronger than expected guidance.
Yeah, absolutely. Thank you, Morgan, for having me back on. So, yeah, no, this was actually, I think, a really strong print for Palo Alto versus expectations. I think you called out earlier, you saw like Fortinet and Checkpoint have some softness, but the guide for fiscal 26, this is their fiscal year end. So the guide came well above expectations. Free cash flow margins, which is a metric everyone's been watching, actually was kind of guided above, call it 38% to 39%. So overall, like this was a very healthy print from Palo Alto.
Okay. What's driving it?
I think you're just seeing cyber demand I think cyber is still pretty resilient. I think the prints that we've seen earlier, I think were more idiosyncratic to some of the specific issues that these other vendors were having. But with Palo, you're seeing the geopolitical landscape, AI, the threat landscape's not changing, right? And cyber is still mission critical. And Palo is an enterprise brand. You can't replace it. You can't pause these digital transformations around security. And with AI and obviously the CyberArk deal, I think Palo is just well positioned to kind of help secure those AI workflows.
And I do want to get more into the CyberArk deal in just a moment here, but you lay it out like that, and I can't help but wonder why names like this the federal business would be considered a risk here if you're trying to become more efficient and more secure.
The federal business for Palo, it's less than 4 or 5%. So
okay.
They do. I would say Palo is probably one of the largest vendors within the federal government, but for them, it's low single digits. So I don't think it's that much of a risk. And for federal, it's again like you are seeing transformations going on within federal, and especially Palo's main business, which is networking. Like you're not going to rip out these firewalls. So for Palo, I still think they're best positioned and will continue to kind of outperform on the federal side.
Okay. So talk to me about CyberArk. Why is this deal misunderstood?
Yeah, for a couple of reasons. I think identity has become central to modern cyber attacks. So like deeper integration with identity data, I think stands to significantly, bolster, Palo Alto's platform. If you're thinking about, privileged access, what CyberArk does is they govern who has access to these models. And then once you're in, Palo essentially then governs what you can do. I think together you're taking the networking data, the cloud data, you have the endpoint data. So all these attributions, I think, combined together do tell a really powerful, story around securing AI. And again, with AI, the adoption trend continues. You're seeing more of these vulnerabilities being discovered. So I think them to combine with an identity asset, which they don't have, which now gives them the full platform, the full stack, I think does tell a pretty compelling story.
Okay. Peter Levine, thank you for joining me.
Thank you.
With shares of both of those names, Palo Alto and CyberArk, trading higher right now. When we come back, our Eunice Yoon is at China's first ever World Humanoid Robot Games. She brings us all the details right after this break.
We're at China's first ever World Humanoid Robot Games. More in just a few minutes.
Welcome back to Overtime. Elon Musk says Tesla's humanoid robot Optimus is key to driving its next leg of growth in the decade ahead. NVIDIA, Amazon, Microsoft, and others are betting heavily on the technology as well. The stiffest competition, though, could come from China. Beijing hosting its first ever World Humanoid Robot Games this weekend, where robots from Chinese companies compete in boxing, soccer, dance battles, and more. Eunice here. She has the details for us. Hi, Eunice.
Robots playing soccer? Maybe not. China's first World Humanoid Robot Games is just the latest in a series of events and programs aimed at promoting humanoid robot technology. The Chinese government is hosting this 3-day event where humanoid athletes show off their skills in martial arts, the 400-meter race. Is it just me or does that guy look tired? And rounds in a soccer tournament. Guo Tong, who programmed one of the futuristic footballers, sees robots replacing his idol Ronaldo. By when? 2050, he replies. Robots have stronger joints and core strength, he explains. Chinese Olympic boxer Li Yang trained this robot to fight in the ring. Robots are easier to coach, he says. Humans are emotional. Not only do the droids slug it out in sports, but at jobs, too. As drugstore clerks, factory workers, and hotel housekeeping. The challenge is for the robot to pick up all the garbage that's in the room, but the referees tell us the biggest challenge for the robots is opening and closing the door. This isn't just fun in games. Beijing has plans to build a world-class industry of humanoid robots by 2027. Designer Wang Xidong says the competition is key. We are refining our robots, he says. Everyone feels motivated to compete. As China attempts to rise up and win the worldwide humanoid robot race.
Even though the 280 teams came from 16 countries, including the U.S., all of the robots were made in China. Morgan?
Who won?
Actually, the company that dominated the medals was a company called Unitree. This is a Hangzhou-based company, and it's seen as a serious competitor to Tesla. It dominated in running as well as in football.
2027, that is not far off to be assembling an army of humanoid robots, especially knowing how much energy consumption and compute it takes to get these things up and running and functional, let alone competing in an Olympics.
Yeah, no, that is the plan, though, and the direction has been set. So because of that, we're seeing a lot of different companies jumping in and trying to get in on the bandwagon with this policy. In fact, Morgan Stanley had said that they expect in the second half of this year that the government is going to make a broader push for adoption by more companies. And they say that because they see more large orders being placed by state-owned companies.
Interesting. Eunice Yoon, great reporting, as always. I remain suspicious that we see a robot replace Ronaldo, though. I'll just say that. All right, still ahead. Novo Nordisk rising 4% after slashing the price of Ozempic by 50%. We get the skinny on the weight loss trade when Closing Bell Overtime comes back.
Betterment.
Welcome back. Japanese markets on the move today as investors make bets on that market. We're going to bring in Guy Adami from Fast Money.
I hear shouting in the background, Morgan. You know what robots will not replace? The genius of Morgan Brennan and the equal genius of Courtney Reagan, who is hosting this fine show in about 11 minutes' time.
They won't replace Guy Adami or the Fast Money traders either, which is why we love having you on this show so very, very much. The Nikkei closed at a record high today. We were talking about what's happening in the bond markets globally a little bit earlier on the show. Want to get your take on Japan.
Let's throw a chart up. Your crack staff back in EC can do this. And if you look over the last 10 years, there have been these 2-year periods where the Nikkei sort of flatlines and then takes the next stair step higher. We're in the midst of one now. And inflation, which is a problem there, I think it's going to be great for risk assets there. And that coupled with the fact that their companies are actually run better. And look at what Warren Buffett, some of the investments he's made over the last few years. I think there's a real good reason that the Nikkei, despite the fact that it's an all-time high, is going to continue this rise. And I do think you're going to see continued weakness in their bond market. I think you're going to see re-accelerated strength in the yen against the dollar in the form of it moving about 147 and change down to 140. And I think that's all going to be very supportive of risk assets there. So, yes, I think you stay with this trade, Morgan.
Okay. Well, if we come back here to the U.S.,
let's
builders,
do that. But let's do it together because
Okay.
I don't like to travel alone.
Okay. All right. Well, let's travel back here to the U.S. because Toll Brothers is set to report after the bell tomorrow. We got NAHB reading as well. Continue to see some softness, some stagnation, if you will, in housing. And yet the home builders ETF is up something like 9% so far this year. We've had a pretty good rally in the last couple days, too. Expectation of Fed cuts.
Let's look at a chart of these home builders. They all sort of topped out many months ago, all precipitous declines, all have retraced about 50%. But for whatever reason, nobody wants to bring up the fact that as of a late June reading, they're almost 10 months worth of new home inventory, the highest levels we've seen in quite some time. For context, history is about 5.86 months of inventory. So we're on the wrong side of that. And I think what we've seen here, in my opinion, in the home builders is just a bit of a bounce off an oversold condition. And as much as people want to make it about interest rates, I think it's more about the underlying economy and some of the softness in the job market, which will not be supportive of these home builders, in my opinion.
All right. How about pharma? Because healthcare has been on a tear, too. And obviously, Novo Nordisk was one of the big stories today, higher after the company slashed the price of its anti-obesity drugs for less than half of the monthly list price. That's for cash-paying U.S. patients. The company also won FDA approval for use of Wegovy to treat certain types of liver disease as well. And by the way, it wasn't just Novo Nordisk that was moving on this. Hims & Hers was lower on this. And then you had GoodRx, which apparently signed this partnership with Novo Nordisk, shooting up something like 40% today. What do you think of the GLP-1 trade?
Throw up an NVO chart. I mean, this is round trip, an entire move from 51. You saw that huge acceleration to the upside, and then you've back and filled the entire move. So I've tried to say on valuation, you can be attracted to, you can own this stock, and I've tried to do it for the last $35 or $40. It's been a bit of a fool's errand. I think the problem with this GLP-1 trade is valuation didn't matter on the way up, and valuation is starting to matter on the way down. I think this is a bounce. I think it's a tradable bounce against sort of $50-ish, which was that prior low, but I'm not putting too much stock in this yet. I'll say this, Eli Lilly has bounced recently, but I think more and more people are starting to look at the valuation of a company that made sense on the way up in the growth trajectory, but is now something that people are focused on the way down. And in terms of the stock and in terms of the valuation they were given 6, 7, 8 months ago, I don't think they're going to enjoy that going forward, in my opinion, Morgan.
S&P today basically closed.
Did you enjoy this, by the way, this little back and forth we had?
I enjoyed it so much. I'm going for a bonus question with you, Guy.
Like the Jonas Brothers, there's a bonus one. I think its name is Sam or something, right? There are 3 of them that sing. They were just an LBI, by the way. I think they played at one of the establishments down there.
Did you go?
No,
You check it out. The 90s are back. The 90s are back. I don't know if you knew that. I went to a monster truck rally this weekend. I got friends going to Backstreet Boys concerts.
No, you did not go to a monster truck rally.
I did, and it was so cool. So, all right. Well, we got
what
the
do you want to
skinny.
talk about? No, what are you, the S&P? You want to talk about the market?
Yeah, we'll talk about the
what was
market. We're range bound and down here. Where do we go from here?
We are range bound and down. So I think people are waiting to hear what Jerome Powell says, not in terms of an interest rate move, because I don't think that's coming, obviously, in Wyoming, but I think some of the rhetoric around what potentially could happen is what people are waiting for. And what I find amazing, and what Doug Cass has written about, and something that I've said for a while, last year at this time, the market was pricing in 6 rate cuts in 2025. I think the S&P was around 5,500. The S&P rallied in large part on the hopes of those rate cuts. Now we're hoping for 2, maybe 3, and we continue this optimism at a much different level in the S&P. So rate cut, no rate cut, I think the market's going to win and lose on valuation and on a lot of companies saying things in terms of guidance. And a lot of the guidance, if you notice, that hasn't been good, companies are being punished more than they're being rewarded.
Okay. Guy, you're the guy.
No,
Appreciate
well,
it.
And by the way, the monster truck thing, I mean, we could all, you with the whole group could have gone, we could have made it like a fast month. Bill's giving me the raps. Okay, Bill,
Okay.
I'm rapping, okay?
Guy
I'll get
dummy.
off set. See you later,
The
everybody.
Fast Money
Goodbye.
crew. We'll see you in a little bit. All right. We'll be back after this break.
Peacock.
Welcome back to Overtime. Let's bring back Mike Santoli for another dashboard and his take on specifically how economic data is holding up after last week's confusing set of reports. Mike.
Yeah, Morgan, it is holding up. I think that's the main takeaway. This is the Citi U.S. Economic Surprise Index that shows how the economic numbers are coming in relative to economists' forecasts. You see it's above zero, not far above zero, so it's not exactly like the results are dazzling relative to forecasts, but it is on a net basis hanging in there. That's in contrast to what happened this time last year. That's late summer, early fall of 2024. Really bad July payrolls report, in addition to some other kind of growth scare type numbers, and that really got everybody concerned and obviously made people think the Fed was behind the curve. Eventually, we got a 50 basis point rate cut in September. So right now, we have relatively slower growth for the first half of this year, but it's coming in more or less as we expect, and there's not a lot of perceived outright recession risk going on right now, Morgan.
All right. High frequency data, is it telling a different story than some of the backward looking data?
It is, as you said earlier, a little bit noisy. It's a little staticky. So obviously the July payroll report and the revisions were outright not good. And some of the ISM survey stuff has also been maybe cause for concern. But then we got the retail sales number, the government number last week, and it was just fine. So I do think that, it's good enough to keep people believing that if we get a rate cut in September, it is into a relatively stable economy for now.
All right, Mike Santoli, we got a minute left here. I got to ask you, I don't know if you've been watching these humanoid robot reports that Eunice Yoon has done.
Yeah.
I got my daughter here, Remy.
Hello, Remy.
She's a big soccer fan. She's got her Messi jersey on, but she's also a Ronaldo fan. What do you think? Humanoid robots, are they coming, and are they going to replace the real thing?
They're coming. I don't think they're coming for soccer players, so it doesn't feel as if. And I don't know if you would want to optimize them for sports, right? It looks like they have a hard time with lateral movement. It was reassuring to me, although amazingly impressive as a show of engineering skill and what they can do for other useful tasks, maybe, but I don't think on the field.
All right.
On
Mike
the pitches,
Santoli.
they might say.
Oh, yeah. Oh, it's good to get your take on this. Appreciate
Okay.
it. We'll see you tomorrow. And Remy, in the meantime, what do you think? You think stocks are going higher or lower from here?
Higher.
All right. Well, we did have a basically unchanged day for major averages, with the S&P slightly lower, the Nasdaq slightly higher. That's going to do it for us here at Overtime as we look ahead to Jackson Hole later this week. Fast Money begins now.
Live from the NASDAQ market site in the heart of New York City's Times Square, this is Fast Money. Here's what's on tap tonight. Retail on deck, reports from Walmart, Target, and Home Depot headline the week. What they'll have to say about the state of the consumer and what it could mean for the stocks. And a big tech breakout? Well, the chart master at least says one Mag 7 stock is primed for a pop. We'll tell you what it is and how to trade that name now. Plus, Intel on the outs after its recent run. Healthy gains for Novo Nordisk after its own struggles. And Citi going on a hiring spree where it's poaching new talent and how it's impacting the banking space. I'm Courtney Reagan in for Melissa Lee, coming to you live from Studio B at the NASDAQ. On the desk tonight, we have Tim Seymour, Courtney Garcia, Dan Nathan, and Guy Adami. But we start with the countdown to the huge slate of retail and consumer names rolling through this earnings season. Home Depot kicks things off before the bell tomorrow, followed by Lowe's and then Target and then Walmart. But that's not all. There are several others to go. Investors are going to be keyed in, of course, to what these companies have to say about the impact of what else? Tariffs. It was a mixed bag for the names today. Target and excuse me, that's not where we're going to go, actually, with that one, because we haven't even gotten there yet, at least for the reports. But for the actual movements of the stock, Target and BJ's Wholesale were leading the way. Over the last month, though, those names have lagged their peers. So what we could hear in the reports that could change the momentum, I don't know. We'll see. Guy, what do you make? Target's been really the big laggard that we've been focusing on so much, especially when you look at the divergence between Walmart and Target. We know that we like to compare them, even though we also know that the mix is different. But if you were to look at these two names now, do you see opportunity before we hear the results?
First of all, welcome.
Thanks.
You're on Worldwide Exchange this morning. You're here now. Yeoman's work, number one. Number
Thanks.
two, I think if you want help in Target being long the stock, I think you're hoping for some change in terms of the C-suite, because this administration over the last 3.5, 4 years has not done a good job. You know that better than anybody. You're not at liberty to say, I will say that. And I think that's what people might be waiting for. Valuation has been compelling for Target for the last 3.5 years. It's been a foolish avenue to go to. Walmart's doing everything right. Target's doing everything wrong. I think if you want to be long the stock, you're hoping that there's some sort of shakeup.
Yeah, I just add that, none of the big box retailers, Walmart, Costco, you could throw like Best Buy,
index in there. I mean, none of them have confirmed the new highs in the S&P 500, right? So if you think about some of the headwinds that, some of these retailers have had as it relates to the potential for a protracted trade war, these, I guess, investors are not saying that they're out of the woods just yet. We knew there was a pull forward, a lot of inventory, right, stocking up against those potential tariffs here. But I do think, over the last 2 months, we've had numerous new highs in the S&P 500, and none of these stocks have really participated. I'm having a hard time just looking at any major retailers that have actually confirmed the new highs in the S&P 500. So to me, that places potentially an opportunity, like if you have beats and raises across the board. I just don't see that happening. And I think that if you do have this better than expected Q2, it's likely not too different than what we saw in Q1, again, about a pull forward a little bit. And some of these names, you mentioned Target. Walmart's an expensive stock. Costco's an expensive stock. You'd say, well, they're always expensive. They always have been. But right now, I think they face a very different challenge than they have over the last couple of years. And it might not be too different than some of the supply chain issues they had during COVID and right after.
Courtney, when I'm thinking about a name like Home Depot, it's an important stock. It's obviously part of the Dow, but it often doesn't move that much on earnings, not as much as maybe some of the other retailers do. But we love to read through the details to see what they're talking about for the housing market. And of course, we have this very tight supply. So if you're going to play a name in housing, do you want a home builder or do you want a home improvement retailer like a Lowe's or a Home Depot?
Yeah, and it's going to be interesting to see how this plays out, right? Because interest rates are still high and a majority of homeowners have mortgages under 4%. So even if rates come down a little bit, there's just no moving on those existing homes. And so what Home Depot has been saying is this is actually good for us because you are going to see more people improving their homes. And they have a lot more of the professional business. They call that their pro business, which really should benefit them. They're expecting actually that to return back to growth here in 2025. So I think the hope is that you start to see that translating. But in the overall housing market, I do think that higher interest rates are still a good thing for your home builders because those existing homes aren't coming on, which means those younger people who want to buy houses, those new homes are what are going to fill the void. At some point, you want to see rates come down because that's really what's going to bring more people into the market. But in the meantime, Home Depot's saying it should be a good thing. We want to see when earnings actually come out.
Tim, there's so much focus on tariffs and the impact of tariffs on some of these stocks. I think we're really only going to see it for maybe half the quarter, and certainly not to the degree that could have been when we heard those first levels from April 2nd. What do you think investors need to understand about what we're going to hear and what the stocks are already pricing in now as it pertains to tariffs?
They need to feel comfortable with the merchandise mix. So those retailers that don't have the milk and eggs component are the ones that I think we're most concerned about. Now, we have to have some understanding also from the retailers. And I actually think this group is going to surprise in terms of where at least consensus is and what this quarter was like. And there are dynamics, especially related to some pull forward. The interest rate sensitivity around Home Depot, I think, is something that's moved the stock. It hasn't necessarily brought more people into the stores. But I think what I want to hear about is that business in between back to school and Christmas, because that's the most important dynamic for the next 4 or 5 months, because that's the part where tariffs will really see people fall off the cliff in terms of demand, or where high credit card bills that Guy talks about this all the time. I mean, there are dynamics on the credit side. I'm worried about everything other than back to school and Christmas. And I think the places that you stay are the places that have proven to be resilient in the face even of tariff conjecture. That is Walmart. That is Home Depot. And I'm going to pay more for them.
All right, Dan, I've got a nerdy question, but we were talking about this before the show.
Impossible.
So Walmart is one of the retailers that warned, look, we use the retail inventory method of accounting. Because of that, and there's a ratio involved with how we get to profitability. It could take some time for the impact of tariffs to go all the way through. So as costs go up, our profitability might be temporarily inflated. Do you think investors understand that? And do you think we're going to see higher profitability, call it false profits, from some of these retailers, a Walmart, a Home Depot, a Target, that use REM accounting, that isn't actually showing us the true profit story?
Well, I think most investors have become really sophisticated about this sort of stuff, right? You'll hear this all the time on earnings calls, like, management's kind of suggest that this is maybe not apples to oranges right here, or the way analysts kind of break it down. So I think those are really important metrics to keep an eye on. It definitely gives a sense of like what sort of goalposts they're using in different parts. But generally, this would play out over a long period of time. I think oftentimes when you see big currency moves, for instance, for multinationals who are kind of of expressing what their profits look like in a certain environment, they often will say constant currency, right? And so it gives analysts and investors the opportunity to kind of compare things apples to apples. But it's a great point, and I think that, oftentimes in different market environments, you will see some investors or some managements kind of use data or use metrics that kind of suit their outlook for a company or an industry.
Courtney, we always talk about the forward-looking guidance more important potentially than the quarter just reported for any industry, right? Because it's backward-looking. Even more important now as we're looking into the back half of the year with maybe a little bit more clarity on where tariff rates are now ex-China, since that's still an extended deadline?
Yeah, and I think that's the hope, is you do hopefully get some clarity when you actually hear guidance. Because when you looked at last quarter, these tariffs were so new and so uncertain that people were either pulling guidance or just not giving any sort of indication of how this is going to affect them. And I think at this point, there's hopefully been enough time and enough certainty in place they can give that guidance moving forward. And we've really had a really positive earnings season. I mean, coming into this, analysts were expecting earnings per share to come in like 3.5% increase year over year. It's on track for over 10% year over year. I mean, it has been a really good earnings season. So I think to see how the retailers come out and how that shows the consumer's been holding up, even with any potential increases, I think that's going to be really important to see with the overall economy.
That's a great point about earnings. Well, Ukrainian President Volodymyr Zelensky meeting with President Trump at the White House today alongside 7 European leaders. The group discussing options for a peace deal that would end the war between Russia and Ukraine, coming off the heels of Trump's meeting with Russia's Vladimir Putin. That was on Friday, remember that? Well, let's bring in CNBC's Eamon Javers for the latest. He's been following every twist and turn. Eamon, what do we know about today?
Well, Courtney, what we know as of about 3 minutes ago is that a White House official just texted me to confirm that the meeting has now ended between President Trump and those European leaders, along with President Zelensky here at the White House. So we should be starting to see pictures at some point of departures of those European leaders out on the south lawn of the White House. Maybe not with all the pomp and circumstance that we saw the arrivals, but nonetheless, we'll keep an eye out for that. And there is a report in German media, which is unconfirmed, but German media reporting that at least their sources are telling them that President Trump stepped out of this meeting to call Vladimir Putin and put the meeting on hold, essentially, while he was on the phone with Vladimir Putin. That is not confirmed. I spoke to some White House officials in the West Wing just a short time ago who said they simply don't know because they're not, the officials I can get to physically are not obviously in the room in the meeting. So we'll wait and see if we can get confirmation on that detail, sort of the idea being a real-time negotiation between all these parties taking place, around the world and in the White House at the same time. But, a real sense of optimism here, Courtney, from President Trump and President Zelensky, and a real effort by the NATO alliance and the so-called coalition of the willing to present a united front in the face of Russian aggression. And we saw the president strike this optimistic tone early on in the multilateral meeting of all the leaders. Here's what he said.
The Alaska summit reinforced my belief that while difficult, peace is within reach, and I believe that in a very significant step, President Putin agreed that Russia would accept security guarantees for Ukraine, and this is one of the key points that we need to consider, and we're going to be considering that at the table also, like who will do what, essentially.
So we'll see, Courtney, if we can get some readout from White House officials on what was agreed to, if anything, in this session. A lot of very sensitive details, as Zelensky said, surrounding the idea of security guarantees for the Ukrainians and what the U.S. role in that would be. The President of the United States not taking the idea of American boots on the ground off the table here, at least for today, Courtney. Back over to you.
A lot of action in D.C. Eamon, thank you so much for being there for us. Obviously, a lot of those world leaders, very interesting to see them all come together. Tim, I want to turn to you for a reaction. I sort of think of you as our global markets guy. Put it all together. What does it mean for us as we're watching potentially some kind of a deal begin to take shape?
Yeah, and someone that lived for 2 years in Russia. So my perspective on this is that it is very complex, and the emotions and the history that have the reason for NATO being what it is exactly, the dynamic with Ukraine is something that I'm just not sure Europe is ready to smile and say, okay, let alone Ukraine. But the bottom line is that the couple things that were my first moves from a markets perspective, when Russia attacked Ukraine, invaded Ukraine, were to buy nuclear and to buy gold and to buy oil. And I do think that the unwind of anything that at least anything less than the current status of where we are, I think given the rally in gold and the rally in nuclear, I think you would see some profit taking and you'd see some pullback. But let's be clear. Those are two trades that are rooted in global dynamics that I think have been at work for a long time. So you'd be buying weakness in gold. And I think you should be buying weakness in nuclear because Russian energy or any energy reliance is something. Ask Japan. Ask Germany. These are things that are really about national security. So I think it's, first of all, nobody cares what I think about that it's a brave face that the world's put forward. I think it's nice that ultimately everyone does seem to be trying to find some solutions and they're all doing it at the table together. I will not handicap an outcome here.
We all care about what you think, Tim. That's why we keep asking you back and asking you questions like this. But the geopolitical backdrop obviously could have a very big impact on our next guest investment strategy. Runs a fund rated 5 stars by Morningstar. Let's bring in Eli Horton. He's senior portfolio manager of the TCW Transform Systems ETF. Eli, it's so good to have you here. Welcome to Fast Money for the first time.
Great to be here.
So obviously we've seen a lot of world leaders meet with the president. It seems like there's some negotiations that might be happening. When we look at the markets in the last couple of days, you would see perhaps a benign reaction, but there's opportunity there that you see. Can you explain to us what you're looking at?
We think the opportunities are abundant, and we're actually looking for them in, I think, places that most investors aren't, and hopefully that's a good thing, be a little different and expect different outcomes. There's a couple, we'll call them mega themes we're extremely interested in. One is the transformation of the global energy system. 2 is the reindustrialization of the remanufacturing of the U.S. I heard the prior comments on Ukraine and the meetings of the White House. And I think that we're migrating from a fossil fuel system to something that's close to 100% renewables. And geopolitical tensions, global security, that is yet another reason why this is happening. Same thing for remanufacturing. So these are themes we're really excited about in today's market.
Can you give us some actionable plays there?
Yeah, absolutely. And the comments on nuclear a moment ago are very relevant. We're extremely interested in the theme of power scarcity and the need for grid investment. So to set the backdrop, in the U.S., electricity demand's basically been dead flat for 20 years. That is now completely flipped on its head. We believe that by 2050, electricity demand doubles. Why? A few reasons. 1, reindustrialization, remanufacturing. 2, electrification of transportation and really our entire economy. 3, AI. And AI gets all the headlines, but it's only about a third of the electricity growth.
I was going to say, I was surprised you said AI third.
It's about a third of the growth. And even with that said, it's fascinating. We need to add something like 75 gigawatts of demand to the grid by 2030 for AI. 75 gigawatts is opaque. It means nothing. New York City has about 5.5 gigawatts of capacity. So what is that, 15 New York Cities worth for AI? So a lot.
That's a lot.
And think about the capital goods and the CapEx to serve this.
Unless you worked there or covered it, nobody ever heard of Vistra Corp over the last decade or so. Became somewhat of a household name in our world over the last year and a half. It's gone from a $40 stock, I think it's north of 200 or right around there, $68 billion. Still reasonable valuation, and the story's obviously out there. Is this a name you can still own here?
I agree. We own Vistra. We've owned it for over 2 years. We really admire the company and their capital allocation decisions, and they have a very valuable portfolio of power generation. So they acquired a nuclear power generation business, Energy Harbor. That was incredibly value accretive. Nuclear power prices have more than doubled, as you've seen from some of the hyperscale deals like Amazon and Microsoft. They also have natural gas. And the fact remains, we cannot add enough wind and solar to the grid to solve for our electricity or power shortage. Can't do it. You need natural gas. Vistra has a very attractive nat gas fleet. We think the company's going to earn more than the street does. We also think the multiple is very reasonable, and it fits right in a bottleneck of businesses that are capitalizing on this theme. And to your point, it's not a household name. Most investors haven't heard of it. most investors aren't exposed to these types of businesses.
Eli, help me out with this. Torsten Slok of Apollo had a note out today. I thought it was really interesting. We all know that 70% of U.S. GDP is consumer spending, consumer demand. And he highlighted the fact that in the first half of this year, that capital expenditures related to AI data center build out actually had the same contribution as consumer spending. And when you think about that, like these are some themes that you're focused on. At some point, there will be a slowdown in CapEx spend for AI, and it might come at the same time that the consumer is having a difficult time and slow down. That changes a lot of dynamics in our economy. I'm just curious, like how you think about that.
You have to watch it. And this is a great reason to not invest passively and to invest with an active investor who's deep in the weeds and doing bottom-up work. That's what we try to do. We have a portfolio of 20, 30 stocks. We try to be in the details and have a differentiated view. With that said, if you look prior to 2023, U.S. CapEx to sales ratios were at 20-year lows. We have chronically underinvested in the industrial goods, the manufacturing footprint, the grid of this country. The average high voltage transformer is 40 years old. So just as we went through chronic underinvestment, we're now on a collision course with structural CapEx needs to grow our industrial base, to rebuild the grid. And so, yes, we're watching it, but we think that this CapEx is very needed and very warranted.
Before we let you go, some of the old economy stocks that you're interested in. Tell us about this theory and give us some names.
Look, we talked about Vistra.
Yep.
There's a variety of businesses. GE Vernova is another interesting one. So we've owned GE since the day it spun out of General Electric. It used to be called GE Power. No one cared about it because nat gas turbines no one wanted one. And in 2023, they produced about half the number of turbines as the prior decade average. Nat gas was left for dead. There's like 3 companies in the world who make these. And so we're able to find some of these old economy companies that have faced headwinds for really a couple of decades as manufacturing moved out of the U.S., that are now seeing those headwinds turned into tailwinds. That drives an acceleration in fundamentals against valuations that are attractive, and that's a nice backdrop for us. And it's a good complement to what's in the broad indices, which doesn't really look like old economy for the most part.
Really interesting stuff, Eli. And your ETF up 17% over the last 3 months, 29% year to date. Thanks so much for joining us here on Fast Money. Appreciate it. Courtney, what do you think? Does theory make a lot of sense?
Yeah, I really like the energy play. I mean, I think there's the fact that there's not enough energy to go around right now is just not. I guess it is starting to get talked about, but it's not invested enough. I mean, when you look at the percentage of energy compared to the S&P 500, it's like, I don't know, between 3 and 4% of the S&P 500. It used to be a much larger share, and that demand going forward is just so astronomical. And I do think he makes a really good point where we get excited about things like nuclear, but there's just, in the short term, there's not going to be enough nuclear to fill the demand. So this is kind of an all hands on deck. So I think some of your older economies, your natural gas, your oils, like those are going to have to fill the gap, and it's going to be a benefit for your entire energy sector.
That seems really fascinating. Well, coming up, we've got new details on the government's reported interest in Intel, just how much the administration is looking to buy and what it would mean for the semi space. Plus, all the news out of Novo Nordisk, a new use case for its blockbuster weight loss drug, and how it's hoping a deal with the telehealth platform will help boost sales. Don't go anywhere. Fast Money, back in 2.
You're watching Fast Money here on CNBC. We'll be right back.
certain.
We'll go back to Fast Money. We have an earnings alert on Palo Alto Networks. Shares jumping after the company reported better than expected results for its latest quarter. Mackenzie Sagalas has the latest. Hi, Mac.
Hey, Courtney. So Palo Alto Networks posting a solid quarter with the stock popping as much as 6% after hours on those results. The cybersecurity firm beat on both the top and bottom line with adjusted earnings of 95 cents a share and revenue up 16% to $2.54 billion. Guidance was also bullish here. The company expects both fiscal Q1 and full year results to top estimates and is projecting up to $15.5 billion in future commitments. And that's a key measure of how much business it already has in the pipeline. And then there is a shakeup happening in the C-suite. Its founder and CTO is stepping down with the current product chief set to take over. It caps a turbulent stretch for the company. That $25 billion deal to buy CyberArk, which is its biggest ever, really rattled investors and shares slid on the news, haven't bounced back yet. So we'll see if tonight's gains hold at the open, Court.
Thank you very much, Mac. Tim, what do you make of Palo Alto Networks? Do you like this bounce?
It's okay. Look, it's been a middling stock. It's been range bound. It's not terribly expensive relative to itself. These were solid numbers, at least in terms of the quarter. They beat consensus by 1.5 points in terms of the top line. The guide, somewhere right in the middle. So maybe a bit of relief, and I think you can own it. But I'm not sure this is where if I'm going to own security, I'm going to own cyber. I'd rather be in CrowdStrike.
Guy, what about you?
I think you can stay with it. I mean, it sold off enough where this quarter was good enough. The guidance for full year 26 was good enough. The growth is good enough to justify the valuation. They're best in breed in the space. So despite this move in the after hours, I think you stay long the name.
It's a curious situation to have the CTO leave weeks after they just make this announcement of a $25 billion acquisition of CyberArk. And so there must have been some things going on there that, the CEO or the board was not particularly happy about. But Guy and I were talking about this earlier today. When you make an acquisition of this size, and make no mistake about it, I mean, this is a massive acquisition. This would be bigger than very near the acquisition that Google made just earlier in the year of Wiz. You say to yourself, what's going on in the space? And Tim just mentioned the stock is very range bound, and at the levels of valuation that these stocks are trading for, if they're going to start becoming roll-ups, I think that they should actually be trading at a bit more of a discount, right? If you have to kind of acquire growth, that sort of thing. So, they obviously made this acquisition thinking of a position of strength when they put this sort of quarter up, but I don't think this quarter and guidance were that good. I think it's a bit of a relief rally here.
Yeah, all three of you kind of go, I don't know. We're gonna move on to Intel. It is down about 5.5% today after Bloomberg reported that the U.S. government is looking to take a 10% stake in the chip maker. Now, the deal wouldn't be a direct investment, but rather the administration would convert some or all of the company's CHIPS Act grants into equity. So initial news of the deal sent Intel shares soaring late last week, with the stock locking in its best week since February. Courtney, this one was wild, I think, when the headlines first came across. We all thought, what? What do you make of the action, of potentially the government stake? Where do you want to take this?
Yeah, I mean, this has been all over the place. I mean, Trump has been for Intel, against Intel. I think what this is showing is probably on the White House's good side, which I think is ultimately probably a good thing for Intel. But I don't think it fixes a lot of the underlying business problems. You're seeing server share loss, their foundry business. The question is what does the future of that look like? And even if that gets rolling the way people are hoping it is, it's going to be years for a break even there. So I think a lot of those problems aren't going to be fixed by this news, but I do think it hopefully just means they're on Trump's good side. That takes away some of the uncertainty.
Guy, what do you think that you can do with Intel here because of all this uncertainty? Is there a trade?
Stay long. I know it's down today, 23 and change. It had that big move north of 25, but I think a floor is in. I've thought it was a Homeland Security play, but I thought it from much higher levels. Now it appears to be coming to fruition, and the CEO goes from being compromised in terms of his relationship with the Chinese to being invited to the White House, and now the administration taking a stake. So I think the floor is 21. That's been sort of the low. I think the upside might be north of 32.
That's interesting. I don't think the government investing in a company like this puts a floor in it or puts some sort of put in it. If you think about what we saw in the wake of the financial crisis and all the stakes the government had to take, I mean, it took a long time for these companies to kind of work their way out of this. And it doesn't guarantee any level of innovation that's higher than what they've been doing for the last 10 or 15 years. And they have had, 4 CEOs and a bunch of restructurings here. So at the end of the day, I mean, the government probably looks at it as a I don't know, free call, if you will. It's a rounding error as far as what our budget is, and they're basically got their pound of flesh. They basically almost pushed the CEO out, and the company has been underperforming in almost every which way. They've missed some major technologies, and they lost massive market shares in some of the ones that they used to do well in. So to me, I think it's kind of dead money, and I'm not sure, again, that the government stake really means a whole heck of a lot for the company.
Very interesting. Dead money, but guy says stay long. Well, there's a lot more fast to come. Here's a look at what's coming up.
Novo playing catch up. The Wegovy headlines pushing that stock higher today, and how a partnership with one telehealth company is giving another stock a booster shot. Plus, even more room to run. Alphabet's put together a big summer rally, and the chart master sees more gains ahead. He lays out the case. Next, you're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this. .com.
Welcome back to Fast Money. Novo Nordisk popping nearly 4% after its weight loss drug Wegovy was approved for the treatment of MASH liver disease. It's the first GLP-1 drug to get FDA approval for that indication. The company also announcing cash-paying patients can now get Ozempic and Wegovy for half the monthly list price, and expanding the discounts to more than 70,000 pharmacies nationwide in partnership with drug savings company GoodRx. That stock soaring 37% for its biggest one-day move ever. Tim, I mean, it's a lot of headlines to keep track of when we're trying to watch the GLP-1 space, but getting another indication feels like only something that is bullish, no?
Well, for Novo, it's been tough to find a bullish call. And as someone that's been long the stock, probably from $15 higher, I'm happy to see this news. I actually think this is news you want to invest around. And I think the price competitive nature between Lilly and Novo is something that at least this is some sense where today the good news for Novo was something that it was bad news for Lilly. Ultimately puts a cap potentially in on the price side of it. It also just emphasizes the DTC business they have through GoodRx. And I think again, with the news we had with Lilly over the last couple of weeks in terms of missing by 1 to 2 percentage points in terms of the weight loss on the most recent phase is something that I just think gets you back to the same argument that people had against Novo. I think, therefore, people are looking at relative value at this point, and I think it's very much with Novo. So it was a good day for Novo. There's been a lot of bad days.
I've tried to make the valuation case a number of times unsuccessfully, but you go back to, I think, the fall of 2022, the stock was mired around $48. It spent the next year and a half or so going from 48 to about $1.50. And then obviously we've round turned the entire move. That's the good news, the fact that we traded down to the breakout levels and seemingly have held. So if you want to play a little stock market against sort of the 49 level, this might be the best entry point you've had in a while.
Well, coming up, is there more bounce left in Alphabet's recent rebound? What the Chartmaster sees in store for the tech giant after its summer in the sun. Plus, Tesla's technicals at a crossroad. Where the stock drives from here, we'll find out when Fast Money returns.
Missed a moment of Fast? Catch us anytime on the go. Follow the Fast Money Podcast. We're back right after this.
Insurance. Welcome back to Fast Money. Stocks closing now near the flat line to kick off this week as investors await retail earnings and Fed Chair Jerome Powell's annual speech at the Jackson Hole Summit. All three indexes moving less than 0.1%. United Health shares, though, continuing to climb, adding to gains after Warren Buffett's Berkshire Hathaway disclosed a new stake, and the beaten down insurance giant shares up more than 22%, in fact, over the last week on that news. Shares of Reddit and Live Nation touching fresh all-time highs today. Well, Hasbro notched an 11-day win streak. That is its longest run since 2017. Shares up more than 9% in that time. Well, JP Morgan is losing top banking talent to Citigroup at a rapid rate. This is according to a new Financial Times report. Citi's banking chief accelerating a push to hire his former JP Morgan colleagues, with at least 10 senior investment bankers joining him at his new home. While shares of both banks are up double digits in 2025, Citi has outperformed JPM by roughly 12 percentage points. Dan, you flagged this story. What do you find interesting about this one in particular?
I think it says a lot about this IPO backlog a little bit, right? So if you think about the lock that, Goldman and Morgan Stanley have had on some of the most high profile, IPOs, this goes back multiple cycles. And JP Morgan started to find himself in that upper echelon. So when you think about a big money center bank like Citi making these sorts of moves, it kind of suggests that this is the time right now, right? And we've already seen some very successful IPOs this year. We know that the last few years have been really bad. So, the idea of kind of staffing up and maybe trying to win some stuff that you might not have otherwise, then I think that makes some sense. And it kind of speaks a little bit, again, to the environment we're in.
Tim, what do you make of this sort of changing colleagues around at the bank and who's going where for what reason?
Well, it's nice to see Citi being able to compete, and it's nice to see a focus on investment banking. And no question, JP Morgan is some of the best bankers in the world. My guess is Citi's got pretty good bankers right now as well, though. The reason I want to own Citi is not because they may be rating JP Morgan's investment banking team. It's because it's still significantly cheaper than JP Morgan. And I think the relative improvement, both in terms of the efficiency of this bank and where they are actually just benefiting from the trends in the broader economy right now, a steeper yield curve. Now, granted, a lot of this could change for money center banks, which have outperformed on the tailwind from regulatory, plus the economy being resilient enough. For now, money center banks still have that backdrop, and I'd rather own Citi. It's cheaper.
Interesting stuff. Well, coming up, the toll that tariffs are taking on auto prices. Which models might cost you more? We'll talk about it coming up on Fast Money. Welcome back to Fast Money. Auto tariffs starting to make their way to the consumer, but some car makers, including one on this board, are actually lowering prices. Phil LeBeau has some answers for us. Phil, can you explain?
Well, basically, overall, what we're looking at right now, Courtney, is that the average transaction price, which is the price that you actually pay, not the MSRP, not something you see splashed on the front of a windshield at a dealership. It's what you pay. It's up 1.5% on average compared to a year ago. That's July to July, according to Kelley Blue Book. The MSRP, which is what the automakers would like the dealers to charge, the suggested retail price, that's up 2.4%. So there's an indication there that the consumers, when they can, are trying to see if they can pull back a little bit. Some of that is through decontenting or looking for a lower trim level. By the way, incentives still remain about 7% of the average transaction price at more than $3,500. That said, there are some brands that are increasing year over year in terms of what the transaction price is. Some of that is because they have newer models and there's some demand there. Some of it is because they have to pass along the tariffs. Cadillac is up more than 10%. So is Land Rover. So is Infiniti. Volkswagen up almost 10% in terms of average transaction prices. And yet, as you mentioned, there are some that are seeing average transaction prices fall. Stellantis is a good example of this. Jeep is down more than 10%, down almost 11%. Tesla, we know the issue there because of the competition. They're having to roll out more of the lower end models for them, lower end. And then you have Acura and Chrysler, obviously another division of Stellantis. Speaking of Tesla, as you take a look at shares of Tesla, a couple of interesting reports today. One is that they're cutting their leasing fees out of the UK because of competition over there. And the other one is that they're rolling out a new model in China, the Model YL, L standing for a longer version. Because long wheelbase vehicles are very popular in China, they need to come out with more versions of vehicles over there because of the competition when it comes to electric vehicles. But Courtney, that's where things stand about 4 months into the auto tariffs, which now stand between 15 and 25%, depending on where a vehicle is built.
So I learned something new, decontenting. I've never heard that as a phrase. I'm glad I learned that.
Go for a lower trim level. Think about going for a lower trim level when you're out buying. You explained it, but I just hadn't heard it. I hadn't heard it used. I like that. And then this new model in China, you're saying, they need more models like this. It's a 6-seater. Do we not like those kind of cars here? Just fill me in on that. They're not popular in the long wheelbase version vehicles have never really been popular in the United States. You can find them if you look for them. They have always been popular in China. Some of that goes back to long ago. It was popular to have a chauffeur drive you around. That's why long wheelbase vehicles have always sold well within China.
Got it. When you're talking about 6 seats, I'm like, I got a bunch of kids. I might be interested in that. Phil, thank you so much. I appreciate the education.
You bet.
Courtney, what do you make of sort of the auto trade, Tesla in specific, the impact of tariffs? Where do you go with these? Are there trades to be made?
Yeah, I mean, honestly, in the auto space, I'm not expecting like crazy growth here, so there's nothing I'm overly excited about. But I do think we're talking about all the tariff costs, which the auto industry is one that's going to be exposed to that probably more than any other industries are. But the other big factor when you're buying a car is how much you're financing that for, because many people buy cars getting financed. And if interest rates come down, specifically the short end of the curve, if the Fed starts lowering rates, which they're expected to do next month, that should be a boost for your autos. Because even if it's going up with tariff prices, if your interest rates are coming down, that may offset some of that and hopefully increase some demand. Again, I don't think this is going to be mind-blowing. I don't think it's something I'm jumping into for a ton of growth here, but I do think it'll be a benefit for the area.
Look at Nikkei is making an all-time high. Toyota Motors, one of the biggest components. The 195-ish level has been resistant since this time last year. I think that's on the verge of a bit of a breakout here. So GM, $60 is the level they got to get through, but Toyota right here at 195, Courtney.
We're going to make a quick turn to Eamon Javers. We understand he has some breaking news on Ukraine. Eamon, what do you know?
Courtney, there's a new report from the FT just in the past couple of moments, and they're reporting that the Ukrainian side is prepared now to offer $100 billion in purchases of U.S. weapon systems in order to get a deal with the United States for security guarantees in Ukraine. No word in this report from the FT on what specific weapon systems those would be. The FT suggesting that money would be financed by the European side, and this might appeal to President Trump's deal-making sensibility in his effort to improve improve the economic situation for American manufacturers. We're also learning that the meeting has broken up, but the president has invited the European leaders into the Oval Office and is giving them a tour. This is described as sort of a more informal, social piece of the series of events that we've had today. But of course, if you're in the Oval Office with the President of the United States, it's never fully informal and it's never fully social. This is clearly an ongoing conversation that's happening, although the formal part of that meeting has now broken up, Courtney.
Great stuff. Eamon Jeffers, thank you very much for the update. More Fast Money coming up. We are going to chart Alphabet for you, see what might be in store for this name. We'll be back. Welcome back to Fast Money. Alphabet shares closing back in on all-time highs, now just over 1% from the record it hit back in February. The chartmaster says it may be due to pass that mark and then some. Carter Worth joins us with a look at Alphabet. Carter, what do the charts tell you?
Hi there. Sure. Let's get right to it. I have a couple tables that might be relevant. The circumstance that's interesting, of course, is so many stocks having sold off marquee big names, Microsoft, NVIDIA, Meta, you pick it, Netflix, Oracle, that sold off with the tariff sell-off, have all recovered all the losses and made new highs. But of course, Google has not. You'll see here in this first table that Google was the worst on the way down, losing some 32% from its February pre-tariff sell-off peak to its April plunge low. Now, the ricochet, second table, depicts the circumstance from the low to present. And obviously, Google's had a tremendous move, up 45%. That's epic, but so has everything else. But the third table really tells the tale. Google has not, made a new high. whereas the S&P index 500 has, the NASDAQ 100, big tech names again like Microsoft, NVIDIA, Meta, Netflix, you pick it, even the tech sector overall or the communication sector. So this is either the opportunity or the problem. I think it's the former, it's the opportunity. Let's look at two charts of Google. First, no lines, no drawings, no annotations. Second, just a simple line or two to the penny, having moved some 45% right back to its former high of February 4th. My thinking is, as has been the case with so many other stocks, Google exceeds its pre-tariff sell-off, breaks out, and makes a new high.
And you mentioned it a couple times here with that one, but Meta, you and Dan were also talking about that one earlier. What do you see here?
Right. Well, Meta, we might have charts as well. Meta did break out, right? And it's almost always fundamentals that cause a breakout. In this case, it was earnings. It was on the 30th of July, and the stock moves above those well-defined former highs. And now sort of backing and filling, you'll see in the next iteration and perhaps the third chart, that the stock is, after breaking out, a little bit dull, a little bit lackluster, but that's normative behavior. And any dipping, further dipping from here today, a bit of a down day, I would say that's weakness to take advantage of rather than weakness to back away from. So I'm a buyer of Meta, it having made the new high and now affording an opportunity to pick up more or initiate if one doesn't have any.
I know you sent out a note on Tesla. We were just talking about it with Phil. What do you see in Tesla here, Carter?
Yeah, we just did a poll. We do these from time to time. Tesla is basically sitting, at the apex of a formation. Some people call it a triangle, some people call it a wedge, but it represents equilibrium, a perfect standoff between bears and bulls. And this is how people have responded. Institutional investors, so it'd be individual portfolio managers or long short, long only, economists, what have you, 60% are positive, calling for the up arrow, 30% negative. It's different on the individual investor side. Only 43% are positive and 57 are negative.
Carter Worth, thank you so much for joining us with those three names, Alphabet, Meta, and Tesla. Dan, I'm going to let you dig in since you and Carter were talking about Meta.
Yeah, Meta's the most interesting of all those names to me. If you think about it, when he's talking about Google, it's gotten back to this point, for it to break out, I think that a lot of things have to happen, probably from a fundamental standpoint. Well, those fundamental things have already happened with Meta, right? And it already did have that breakout. It's consolidated above those prior highs. I know a lot of folks have kind of relied a little bit on that valuation that had been favorable until recently. It's not that favorable, but I like it from a technical standpoint. I like a lot of things that they're doing. I like the fact that they keep trying to fix their AI business. They're on their fourth, restructuring of that right now. Sooner or later, they're going to get right, and Zuckerberg keeps spending hundreds of billions of dollars on that, build out hundreds of millions of dollars on hiring people.
Keep trying. Well, it's almost time for your final trades. They're coming up next. We'll be right back.